Good day, welcome. Today we're going to discuss when to buy the dip part 2. Um, Last week we have discussed this subject already, and I felt that I had to make a new video regarding this subject. Um, for the simple reason that I'm constantly getting questions about coins that are already moving with what's this target, where can buy, when to buy dip. So I think it's an important subject to refer to. And yeah, mainly the people who are asking this without any background are people who are trading with like a few $100, trying to get that golden ticket towards higher standards, and then when they get there, they will lose anything at all because they're just not reflecting what they are doing. And in trading, you have to reflect and evaluate what you are doing, otherwise your portfolio will be hurt. And I guess it's the same with what you're doing in your life. You should always reflect and evaluate your approach to certain things in life and learn from the mistakes you make. So today we're going to discuss theoretical background behind when to buy the dip part 2, a little bit more into deep. The difference between when to buy the dip and how you should approach it. We're going to discuss it through 3 coins. So yeah, that's it. There's no market review today as the market is relatively stable. Tomorrow there's going to be a new major Saturday, and on Sunday an altcoin Sunday. I'm getting questions why I'm not in front of the screen. Well, I've discussed it in the previous videos. I'm just building up my YouTube channel before I'm going to move to a more to a different setting in which I can build a studio, and then you will see me in front of the face as well. And then we're going to do more videos on TA, interviews, podcasts. It's all coming up. I'm actually also going to do webinars and workshops with my new partner Miet. If you're Dutch, check it out. He is doing a really good job as well. So then, repeating from the previous show, we have to discuss a few topics. Why? Well, they are essential, and through repeating statements and important stuff, you will remember it at some point. Usually people don't remember it at first, but when something is said twice, there's a higher chance that people will start to remember it and maybe even start to act to it. The classic example is to buy green candles and FOMO as the social media engagement goes up, which we have seen with Silica, Cardano, Matic, whatever it is, to a certain degree. And when the FOMO is there and when the social media engagement goes up, people tend to lose their emotion and lose their mind, and they want to get into the boat as they don't want to miss the upwards potential. However, you should become interested in certain coins when there's literally no discussion or when people are saying that it's dead. You should have, essentially when you're swing trading on the higher time frames, you should do some fundamental background on coins. But for instance, for Silica, you've had about 8 months inside an accumulation range to accumulate, but then you're not interested. You're only interested when somebody says it's going up. And when somebody is saying it in an accumulation range, there's no green candle, so there's no emotional trigger to miss the boat. So you have to adjust your mindset in order to be consistently profitable in this market, as it's a heavy volatile market. Differences. Well, by being too late or having an adaptive strategy, there's a different plan for different altcoins given their fundamentals. What I want to say with this is that based on the time frame, there's a certain different approach. So when you read something on social media and you see a chart based on the 1 hour and 2 hour, that's a different trading plan than when you see someone saying it on the daily time frame. As when someone is saying it on the daily time frame, he's going to swing trade it. But if you have a day or scalp trade approach, you have a different scenario and you are using a different time frame. In the end, it comes down to the same risk-reward ratio approach, but on a lower time frame, you should be aware that there's just a different strategy behind it. So if you want to trade these smaller time frames, you should be able to understand the large time frame first. So you should be able to understand that a coin is moving into an upwards trend or a downwards trend or accumulation based on a larger time frame, based on what you see on the EMAs or what you use for the trading. And then you can zoom in, as the levels on the larger time frames always apply to smaller time frames as well. Meanwhile, it's getting a storm over here. Hopefully you don't hear it on the video. The next part about differences is that there's also a difference in between coins, their usage. For instance, the difference between trading ThetaView or trading Cardano is that Cardano has majors, which is a major which is providing more volume and liquidity to the markets, thicker order books, through which the PA is just more natural, rather than a coin like ThetaView, which is a small cap and actually a second coin on the blockchain Theta, which was pumped because of Theta that went up. However, there were thin order books, and through that, one big whale can just offload their stack and destroy the whole chart. And by knowing that, you should decrease your sizing, as in the end, your own portfolio is what you should care about, no matter where the market is going. In the end, your portfolio should pay your bills and your life. The market is not going to do that for you. So the same approach was there with Bond Protocol. We have discussed that in a previous show as well. Bond Protocol doesn't really have any volume in the books through which you see these wicks. When somebody sells like 10 BTC worth of the coin, it goes through the order books, and then you're likely getting stopped out on your position, as then there is just no support and resistance level. So adjust your sizing due to the market capitalization of a certain altcoin. And what we just have discussed is that you should use more sizing on Theta than on TView, as Theta is 10 times larger in market cap than ThetaView and has more liquidity in the order books. So there is less risk of being stopped out by a market sell or whatever different variable there is. And the same approach is there for Cardano, that's bigger than Theta, so you can increase the sizing there as well. However, it's also caring about the time frame, lower time frame, lower sizing, higher time frame, higher sizing, and always have a plan when you start trading. So what I just said is the liquidity is higher on majors, so you can trade with higher sizing, as you can easily have a stop loss tied on these, unless you are on a future platform like Binance, in which there are constantly scam wicks. Also just said, your portfolio is the crucial part in this. Nobody cares about your portfolio except for yourself. If you lose, your neighbor won't care. If your neighbor wins or loses, nor should you care. So stop using social media as a narrative or material to compare yourself with. You and yourself, and only you, should adapt and increase your knowledge in understanding the markets, which means that if you join a group, there's nothing wrong with joining a group. You can join every group you want. You can join mine, you can join someone else's. You're happy and free to do so. I'm not going to blame any of the other groups. However, if you join a group that's only giving you signals, you're not learning anything at all. I advise you to join a group where you can actually be educated and just improve your knowledge and increase your knowledge on what trading actually is and the psychological background of the trading itself. TA is just 20%. The rest is about your mindset, risk management, understanding the market flow and the market sentiment. So the only way you should use social media should be through gathering information to use for your own analysis or to confirm it. The basis is your own TA and your own view. Social media is a variable through which you can confirm or deny your own analysis. It's not the case that social media is giving you a certain analysis and then you're going to use that for your trading. It's the other way around. Finally, the more complex a chart is on social media with like 20 indicators, the more dog shit it usually is, as the one behind it doesn't even understand what he's saying. But that sizing part, something more about it, yes. I know it's pretty much boring as I'm speaking for 10 minutes now, but I find it important to include this content in my YouTube channel, as we are going to have more content based on this So we have to build up some technical and theoretical background on what I'm doing on my charts, so you can maybe understand what I'm saying on the charts. An example: if you have a portfolio of 10 grand, you should not be trading with more than 1.5k to 2k. The other 8k should be in long-term investments and not only in crypto. That's my approach. So this is just a virtual portfolio in which you have 10k. From that, about 8k should be in long-term investments, which makes your mind clear. You're not trading with everything, so you cannot be stopped out heavily on your portfolio. You don't even care about intraday movements for your long-term investments, and you're just accumulating. So with the long-term investments, I'm currently in cash, crypto, and commodities, and I generally don't really care what's going to happen inside a week. If it drops, I accumulate more. If it goes up below the standard that I have, I just accumulate more as well. With the trading part, your maximum risk shouldn't be more than 5 to 7%, which means that some people are joining an altcoin all in on their trading portfolio without even a plan and just expecting to see a market increase and to be rich overnight. Well, hello, that's not going to happen. Maybe once, but it's not going to happen after that. The chance of getting wrecked are just higher. So if you're trading with 2 grand and you want to take a trade on Cardano, it's fine if you want to take the all-in trade, but you should be aware that your stop loss should be maximum 5 to 7% if you trade all in. With data view, with the low sets and the high risk, you should not be trading at all like $500 max with the same max risk approach. But by having this, your overall risk on trading is not more than 1.5–2% of your portfolio, and if something goes wrong or you have a bad streak, you still have your long-term investments, which you don't really touch. If you make profits consistently on a day-to-day or monthly basis, you can increase your long-term investments to the same standard as I've just said, in which 15 to 20% is trading. If your long-term investments go up and your trading is like 5 or 6%, you can increase your trading, but if you feel uncomfortable with trading a large portfolio, you can just have a lower risk approach in which you're feeling comfortable. So, how are you trading your strategies? If you want to swing trade on a coin, you have a different strategy than when you're scalp trading. In scalp trading, you're using lower time frames, for instance 15 minutes, 1 hour, 4 hour, with lower targets, which means lower stop loss levels or tighter stop loss levels actually, which in the end creates a proper risk reward ratio. In swing trading it's the same, but you have higher time frames and wider entry zones, which means wider targets and wider stop loss levels through which your risk reward should be identical to scalp trading levels. Every time your risk reward should basically be the same. If your risk reward is lower, your sizing goes lower as well. If it goes higher, then you might be living in a different world, but if it increases, you are able to increase your sizing as well. Well, let's get to some charts in which I've made a few of them, and the first one I'm getting many questions about is Cardano, in which you can see that we got a daily time frame over here, and the red levels are higher time frame resistances, in which based on the daily time frame you can see that we've got a support level over here, we've got a support level over here, and we've got a support level over here. So what should be the approach if you take the daily time frame after hitting this resistance? Well, a retracement can take a serious period of time. As you can see over here, it took about 2 weeks before it get towards the support level, but over here the same conclusion is there. If you trade a daily time frame, buying the dip takes time, and if you want to buy the dip, you size in through this zone. You're not going to buy 100% through one level, as that's too high in risk. You want to get the best entry possible with the lowest risk possible, so you start to size into this zone. Daily time frame next level is around here, best zone is around here, in which you can probably use a strategy in which you buy 50% here, 50% here, take your stop beneath this low over here, in which the targets are the same as over here. However, if you go towards the 1 hour time frame, you can see that you didn't see this support level on the daily, as it's just covered into the daily candle, but on a 1 hour time frame you can see that the price flipped this higher time frame support for support, came back again, took the liquidity below the low and started to run to the upside. In this case, you're charting on the 1 hour time frame, in which you look for the long in this zone, which should take a stop loss probably a little bit wider than this one. But as you accumulate in this zone and have a tighter stop loss, your target should be lower than on a swing trade. If you want to take the swing trade, you're going to look for the 4 hour and daily time frames, through which you know that there's a higher chance of longer accumulation or retracement. In this case, you're on the 1 hour time frame, in which you're also basing the targets on the 1 hour time frame, which means lower targets, lower stop loss. So in this case, your stop loss is here, while on the daily time frame you can't even see the support level, through which your targets should also be based on the historical movements, in which this higher time frame target is there already. Alright, so then if a coin moves through your target and goes towards a higher level, so what? It's your portfolio. You've made a great trade, you've made profit, so you go to the next trade based on your own risk management plan and your portfolio management. You don't care where the market goes, you just want to make profitable trades. So in this case, Cardano, we have got different time frames, different plans. You can see that on the 1 hour time frame we had a bearish divergence and took the liquidity, in which you could have made a short. Now we're losing support over here. So if you want to take a scalp trade on this one, I'd just generally be waiting through to see support over here or here again, or reclaim off this lower time frame support before I take the entry. But so you can see that buying the dip has a different name based on the time frames. And buying the dip, I mean usually on the larger time frames, in which we get a healthy retrace inside an uptrend. Previous support level is a previous resistance level is becoming support, through which buying and accumulating in these zones with a stop loss can generate the best strategy than trying to get the top. Another example is Stellar, which finally starts to get some momentum, in which we're still inside the range. I've discussed that Silica, for instance, was also still inside the range. Price came back to previous support levels, larger based on the daily time frame. But if you want to take the swing trade, larger time frame, then you know you should be watching the daily. And for instance, if the daily breaks up and consolidates here, that's also providing a support level. But overall, you see that every time there's an impulsive move, price comes back for the back test. Over here you see it as well, nice rally to the range. There's no entry here, as your stop loss is beneath here, as it's going towards, as you're charting towards the historical price movements, which means that this is your stop, and if this is your target, you could have a nice okay trade. But if you take the trade here with the same stop loss, your IRR is way better, and you should be, in that case, you should only be right less. So in this case, we fully retraced back to the previous support level, confirmed it again a new rally, and now we have confirmed the area and the order block on the daily time frame here for support, through which we are again tapping into the resistance zone. Now, if you check the daily time frame, you want to see support based on historical price movements, in which this area around the green zone, around 780, 790, needs to flip for support, as then it becomes a support resistance flip. And otherwise, I'm going to look around 750, or I'm going to look for the breakout and retest above gray. If you look for the lower time frame case, in this case, you can see that on the hourly we have already flipped here, so this granted for a support and for an entry. The same occurs here, and probably the 1 hour is gathering a entry over here for a backtest. The same approach here, support resistance flip, support resistance flip. So on the 1 hour time frames you get nice scalp entries. However, based that this is the 1 hour time frame, you should also be aware that there's a lower target zone, as it's the 1 hour. The daily is used for larger time frames, the 1 hour is used for lower time frames. So in this case, you should be, if you take the entry based on this support level on the 1 hour, you should also be watching lower levels for targets and TPs, as your stop loss is tighter. However, if you take the daily and you are seeing an accumulation and a nice support resistance level on the daily time frame, you can take a wider entry zone in which you take a wider stop loss level in which the targets are way higher, in this case 1250. So conclusion, if I say something about buy the dip, I'm more a swing trader based on the 4 hours daily. That's also because I've got my own group and people just don't have time to watch it all day. I'm just saying that when something retraces on a daily time frame, it takes time. And when it gets there on a previous support resistance level, then you want to take the entry. The moment that everybody is expecting further downside and the overall social engagement go down, that's the moment you want to take the entry. Thank you for watching for this video, and I'll be back tomorrow with Major Saturday. If you want to see some topics, please reply. If you like this video, please like it, subscribe to the channel, send me a DM on Twitter, or follow me on Twitter as well. Thanks, and see you next time.